This is a price chart of the Nifty 50. For most of the trading day, the index tracks a relatively stable trajectory. But recently, right at the close of the market, the line violently snaps upward. Since August 3rd, the Indian equity markets have repeatedly seen these massive, instantaneous spikes. On a typical day, we are looking at a 140-point surge in the benchmark index, with only minutes left on the clock before the closing bell. This chart shows the direct relationship between that late-day index movement and the derivatives market. While the underlying index jumps, a near-the-money 0 days to expiration, or 0 DTE, option premium experiences an exponential explosion. We are seeing contracts priced at 15 rupees skyrocket to 115 rupees in a matter of minutes. Retail buying volume and standard end-of-day volatility cannot account for price action this aggressive. This is the signature of a predictable microstructure exploit. Large institutional players have identified a specific window where current market mechanics allow them to extract capital with high precision. The 325 anomaly suggests a new structural variable has been introduced to the Indian market, one that allows a specific type of trade to move the entire index in the final minutes of the day. To understand how this exploit functions, we have to look at the underlying architecture of the Indian financial ecosystem, specifically the National Stock Exchange. Every financial market is split into two primary segments. There is the cash market, where actual shares of companies are bought and sold, and the derivatives market, where participants trade futures and options contracts based on those underlying shares. In Western markets, like the US, the ratio of cash liquidity to derivatives is roughly 1:4. The cash market remains robust. By contrast, high transaction costs in India push this ratio to an extreme 1:300. The massive futures and options market derives its price directly from the underlying cash market. Because the cash segment is comparatively tiny and thinly traded, whoever can move the cash market gains outsized leverage over the entire derivatives market. Any regulatory mechanism that makes the already thin cash market easier to move instantly creates a highly lucrative vector to manipulate the massive derivatives market. Until recently, the final closing price of an Indian stock was calculated using a 30-minute volume-weighted average price. This required sustained buying or selling over half an hour to move the needle. But regulators recently replaced that system with a brief closing auction session, or CAS. The intended macroeconomic goal of the closing auction session is practical. It allows massive passive funds to execute large block trades exactly at the daily closing price without distorting intraday charts. This mechanism is standard globally. On the New York Stock Exchange, the closing auction is a smooth, highly liquid process. The same is true at the London Stock Exchange. European markets absorb closing auction volume efficiently every single day. But these markets rely on two crucial structural pillars to function. They have robust short-selling mechanics and utilize designated market makers, who are legally required to step in and provide immediate liquidity if market order imbalances get too severe. India's architecture lacks these safeguards. The stock lending and borrowing mechanism is heavily restricted, and the auction window functions without designated market makers. Importing a Western execution mechanism into a market with intense liquidity constraints and zero stabilizing friction turns the final minutes of the day into an opaque, highly exploitable environment. Here is exactly how the exploit is executed. At 3:15 p.m., standard continuous trading ends, and the closing auction session begins. During this window, trading volume plummets. Liquidity in the CAS drops to roughly 1/10 of the already thin intraday cash market. This chart visualizes the benchmark index composition. The index's movement is dictated by a handful of heavyweights, like HDFC, Reliance, and ICICI. In the final moments, an institutional player targets these specific stocks. A concentrated flood of buy orders rapidly drives up their prices. As the prices of those heavyweight stocks inflate, the exchange's algorithms automatically force a massive upward recalculation of the final index closing value. By deploying a relatively small amount of capital to shift prices in the illiquid cash market, institutions successfully dictate the final settlement price of the multi-billion-dollar derivatives market. The collateral damage from this exploit hits retail traders immediately, but the deeper systemic risk lies with systematic option sellers holding short gamma positions into the close. Risk management models are built for normal market dynamics. When an option contract violently reprices from 3 rupees to 150 rupees in seconds, standard stop-loss protocols fail. These instantaneous moves push deeply out of the money contracts instantly into the money. This generates severe margin deficits for the client, and if the client cannot cover the loss, the financial liability cascades directly onto the broker. Without intervention, a localized trading exploit has the potential to trigger a systemic default event across the brokerage ecosystem. The technical solution is displayed here. Regulators must decouple zero DTE derivative settlements from the cash market's closing auction. By establishing a strict volume-weighted average price reference at 3:15 p.m. exclusively for intraday settlements, the F&O market is locked in before the auction begins. True market integrity requires infrastructure tailored to actual local liquidity conditions. Isolating derivatives from the closing auction removes the incentive to manipulate the cash market, and it is the only mathematical way to disarm the exploit.